Good morning dear learners and welcome you all to the 8th module of my course on financial literacy. I, Dr. Vandana Sonkar, Assistant Professor, Faculty of Commerce, Banaras Hindu University, welcome you to the lecture number 38, Deductions and Exemptions in Personal Taxation. In this particular lecture, we will be going to discuss the various types of tax exemptions and deductions that are available to different types of assessee according to Indian Income Tax Act 1961. In the previous lectures of this module, we had discussed about the tax planning, tax management and the various aspects related with the tax evasion, whereby we had discussed how by claiming the different kind of exemptions and deductions on the calculation of the taxable income and total tax liability of any assessee, we can manage our tax burden and we can also reduce our tax liability. This will not only be going to help to minimize our tax burden, but it will also help in enhancing the saving and maximizing the investment. That will again be going to help in the capital appreciation for the individual. So in today's lecture, we'll be going to discuss about the different types of tax exemptions, tax deductions, the key differences between the term tax exemption and tax deduction. Many times, many individuals understand both the concepts as synonymous, but both are different from each other. We'll be also going to discuss the various list of exempted incomes that must be taken into care for the purpose of calculating the total taxable income of the assessee, and we'll be going to discuss about the various aspects related with one of the exempted income, that is the agricultural income. So in the agricultural income, we'll be going to understand the various aspects related with the calculation and tax liability related with the agricultural income of an individual. And the last of the lecture will be also going to cover some aspects related with the special economic zones for the corporate sectors, for the business entrepreneur, the different deduction and exemptions that are available under the special economic zones under section 10AA and of the Income Tax Act are very important for the calculation of tax liability. So let us start the discussion with the understanding of the concept of the tax exemption. Basically, tax exemption refers to certain type of income or financial benefits that are entirely, or you can say fully or partially sometimes excluded at the time of computation of the total income of the assessee for calculating taxes. So basically, as per the income tax, exemptions are the different kind of income that may be partially or fully exempted at the time of calculating the total taxable income. So these are allowed to the individual so that they can save money for their essential needs such as housing, retirement planning, healthcare facilities, etc. So key characteristics of the tax exemptions are: it reduces your gross total income before the tax is calculated. So suppose that if your income is 10 lakh rupees and you get any exemption on any particular income of rupees 50,000, then your total income for the calculation of taxes will be 9,50,000 rupees, that is 10 lakh minus 50,000 rupees. Mostly it is governed under section 10 of the Income Tax Act, and exemptions are not claimed like deductions. They are automatically excluded at the time of computing the total taxable income of the assessee. That means you do not need to calculate first your total income and then deduct the amount of deductions for the calculation. Automatically, all the tax exemptions are excluded at the time of computation of total income. Now, Let us understand the next concept, that is the tax deduction. Basically, a deduction is a specific amount that a taxpayer can subtract from their total gross income, and thereby they can decrease their taxable income. So ultimately it is also going to decrease your tax liability, and this kind of procedure of calculating the taxes by claiming your deductions known as the tax deduction. So deductions are basically, you can say, certain kind of reliefs that are provided to the taxpayer after calculating their gross total income. So they can deduct all those deductions by claiming it and providing sufficient documentary evidences for that, and then the total taxable income will be the result of deduction of the various types of deductions that they claim. So suppose that if your income is 7 lakh rupees and you invest rupees 1,50,000 rupees into any eligible financial instrument that has been covered under section 80C of the Income Tax Act, such as LIC or PPF, or you can say NSC certificates or mutual funds or multiple other kind of the investment avenues are there. If you have invested in any one of them, then you can deduct the amount of 1,50,000 rupees for the saving into such kind of financial instrument that are allowed under the section 80C. So your total taxable income in such case will be 5,50,000 rupees only. So tax will be calculated on 5,50,000 rupees instead of the income of 7 lakh rupees, which is the gross total income for the SSC. So here you need to understand that deductions are basically deducted from the income of the assessee after calculating the gross total income, whereas exemptions are excluded while calculating the gross total income of the assessee. Here, an important thing you need to remember that under the new tax regime, which is now known as the default tax regime for the assessees, does not allow taxpayer to claim so many deductions. If an individual expenses and investments are structured in that way that they allow them to claim these deductions, they must specifically opt for the old tax regime. So the old tax regime, which was relevant in the previous and the current assessment year, that may be opted for claiming the different type of deductions that are allowed to the assessee under section 80C and under various types of other sections from 80C to 80U. Now, let us understand some of the key differences between the tax exemptions and the tax deductions. So basically, tax deductions lower your taxable income by subtracting certain expenses and investment that may be allowed to any individual assessee from the various list of deductions discussed under section 80C up to section 80U. Tax exemptions, on the other hand, simply remove the specific type of income from being taxed entirely. For example, the agricultural income, this is not added into the calculation of gross taxable income of an assessee while calculating their income. So, for example, suppose that maximum deduction of rupees 1,50,000 can be claimed under section 80C for investment in PPF, equity linked saving schemes, EPFs or NSC. Whereas for in case of the tax exemptions, certain type of incomes like agricultural income, allowances, HRA, LTA are exempted either fully or partially while calculating the gross total income of the assessee. Now, the next difference is that by offering tax deduction, the government try to encourage and promote the habit of saving and to encourage investment into the economy by the saved amount of the individual. So it has a broader impact on the saving and investment in the economy, whereas tax exemptions are offered because these type of exemptions promotes certain specific kind of economic activity, such as agricultural investment will increase when there will be no taxes on the agricultural income. After that, deductions are subtracted from the gross total income, whereas exemptions are not included at the time of calculating the gross total income. So these are the various differences between the two. Now let us understand the various types of features or characteristics of the tax exemption. So certain incomes such as agricultural income and other type of incomes are excluded while calculating the gross total income. So these are known as the exemptions. So there may be house rent allowance, education allowance. To certain extent, either fully or partially, they are excluded at the time of calculating the taxes. So basically, income which do not form the part of total taxable income either fully or partially, as discussed in the Income Tax Act, may be the exemptions in case of the calculation of total income of the assessee. Now the various list of exempted incomes are under section 10 subsection 1, agricultural income is there, which is fully exempted. That means if any assessee in the India earns any income from the agricultural land, then this type of income will be fully exempted at the time of calculating the taxes. Then share of income from Hindu undivided family under section 10 subsection 2. So income received by any member from the Hindu undivided family will be also exempted at the time of calculating his or her taxes. Then section 10 subsection 2a, share of profit from partnership firm. This is also exempted in the hands of partners, as the firm already pays taxes on their profits and gains. Section 10 subsection 5, leave travel concession LTC. It is also exempted if you travel within the India, certain conditions may be applied there also. Section 10 subsection 6, remuneration for foreign diplomats. This is also fully exempt if they are notified by the government of India. Then comes the section 10 subsection 10, gratuity. So any income of gratuity, if it is received by the government or non-government employee, in such cases the income is exempted up to rupees 20 lakh for non-government employee, whereas for the government employees, whether they are central or state government employees, the gratuity income is fully exempted from the taxes. Then section 10 subsection 10a, commuted pension, fully exempted for government employees, partly exempted for other type of employees in the country. Section 10 subsection 10aa, for leave encashment, it is fully exempted for the government employee, and it is exempted up to rupees 3 lakh for other types of employee in the nation. After that, section 10b is there, which is for the retrenchment compensation. It is exempted up to rupees 5 lakh of rupees. Then section 10 subsection 10c, voluntary retirement scheme. Under this scheme, if any of the employee receives an amount of rupees 5 lakh, then the amount will be exempted at the time of calculating their total taxes and taxable income in the particular year. Then comes section 10d, life insurance proceeds. So maturity proceeds is also exempted with condition on premium and policy date. So you need to look into the conditions related with the policy and the premium dates. Accordingly, this income is also fully exempted. Then comes section 1011 for the provident fund. If it is a statutory or public provident fund, then interest and maturity. In this case, it is fully exempted if conditions are met that is discussed under the EPF tax free if the contribution is more than or equal to 2.5 lakh rupees per year. Then there is section 1012, recognized provident fund, maturity is tax free if the service is more than 5 years. Then house rent allowance is there, section 1013a, partly exempted on the basis of rent paid on the salary that the assessee receive and the type of city in which they reside. Then section 10(14) is there. Certain allowances such as LTA, conveyance, uniform, tribal area expenses, these are also exempted up to certain limit as discussed under the Act. Section 10, subsection 15, interest on tax-free bonds are there. These are fully exempt income. Section 10(16), scholarship, these are also fully exempt for the educational purposes. Then section 10(17) is there, income from member of parliaments and MLAs, all the daily allowances and the constituency allowances that are paid to them are fully exempted. Section 10, subsection 17A, awards or reward that are notified by the government, that is also fully exempted from the taxes. Then section 10, subsection 18 is there, pension to gallantry award winners are there. This is also exempted from the calculation of the taxable income. Then section 10(19) is there, income of armed forces. So all the defense and army personnel who receive income from the various sources, these are also exempted under certain special circumstances discussed under the Indian Income Tax Act. Then section 10(26), income of tribal area residents, it applies to certain scheduled tribes in northeastern state of the country. So only that particular area, who the citizens who live in the northeastern states of the India, for this exemption is allowed. Then section 10(32), income of a minor child, it is exempted up to rupees 1,500 per child for a maximum of 2 children if the income is clubbed with the parents' income. Then section 10(34) is there, dividend income that was earlier exempted but now it is taxable, and exemption is withdrawn from the year 2021-22. Section 10(46) is there, income of specified authorities and funds and institutions are there, such as SEBI is there, Insurance Regulatory and Development Authority of India is there. For all these organizations and funds and institutions also, the income is fully exempt as notified by the Government of India. So most of the exemptions that we have discussed, these were available only under the old tax regime of our country. Under the new tax regime, under section 115 BAC, most exemptions and deductions are not allowed from the current financial year, and in the assessment year that will be taken into consideration for the calculation of income in this year, these exemptions and deductions may not be allowed to an SSC. So except under standard deduction from the assessment year 24-25, most of the deduction and exemptions may not be available to the assessee. Now, the first part of the exempted income, that is the agricultural income. Let us discuss what is agricultural income and why it is exempted from the calculation of the taxable income of the assessee. So, agricultural income basically refers to the income earned, that is earned from the agricultural land and related activities such as rent or revenue from the agricultural land in India. So there are various categories of the land in India, such as commercial land, residential land and agricultural land. So if there is any agricultural land and you get any revenue from that, then that income is known as the agricultural income. Then income from agricultural operations are there, like sowing, harvesting or tiling. Then income from farm buildings required for agricultural operations, that is also agricultural income. And sale of produce grown on the land without major processing. So income that you receive by selling wheat, rice, vegetable, etc. may be the part of agricultural income. So earning from selling like crops and income from leasing agricultural land, profits from farmhouse used for agricultural process may be a part of the agricultural income of the assessee. Now let us understand what may not be the part of agricultural income, which are the income that has been excluded from the agricultural income. So any income if you receive from poultry farming, then this will not be the part of agricultural income. income from processing beyond the basic level, such as for the marketing, branding, and any kind of packaging and labeling is done and processing of the food grains are done, then these types of processing beyond the basic level, if you receive any income from these sources, then this may not be included in the agricultural income. Then income from tree plantation like timber may not be included into the income from agricultural income unless it is from the natural forest land. Then comes the income from beehiving. If you receive any income from the beehiving activities, then it is also not the part of agricultural income. So the tax treatment that is done for the agricultural income in the Act under the section 10(1) is basically it is fully exempted if it is earned within the country's border, if it is earned into India. However, if the agricultural income exceeds an amount of rupees 5 lakh and the non-agricultural income of the assessee is above then the basic exemption limit, in such cases it is considered for rate determination using the partial integration method for the purpose of computing the taxes of the assessee. So let us now know what do we mean by the partial integration method. Here we are exhibiting some of the partly agricultural and partly not agricultural income of the assessee. In cases if you are earning income from growing and manufacturing tea, then under the rule 8, 60% of the income is perceived as the agricultural income, whereas 40% income may be taxed and it is perceived as the non-agricultural income. In case of rubber manufacturing business, under the rule 7A, 65% income is agricultural and 35 is non-agricultural. For coffee grown and cured by seller, under 7B subsection 1, 75% income is agricultural, 25% of income is non-agricultural, and coffee grown, cured, roasted and sold is under section 7B 1A. 60% of the income is agricultural and 40% is non-agricultural in nature. So now let us understand the rule of partial integration. How, according to the rule of partial integration, in case of agricultural income, the taxes are calculated for the assessee. Basically, it is a method that is used to determine the tax rate on non-agricultural income of the assessee when they are having some agricultural incomes also. So while agricultural income is exempt under the section 10(1), it may affect the tax rate that is applied to your taxable income from certain other sources if the certain conditions are met. So when it is applicable, basically when the net agricultural income of the assessee exceeds rupees 5,000 and non-agricultural income exceeds the basic exemption limit of 2,50,000 rupees. So now let us understand step by step how this particular principle works. Suppose that if any assessee is having 6 lakh rupees as income and this is non-agricultural in nature, and 2,50,000 of income which is agricultural income in nature, and he is of the age of 30 and basic exemption limit that may be given to him is 2.5 lakh rupees. In such case, for calculating the tax rate, we will take into consideration the following steps. Step number 1, add both the income 6 lakh plus 2,50,000 rupees, that is 8,50,000 rupees total taxable income. Now calculate taxes as per the slab rate tax system as if this is only the taxable income of the assessee. After that, in the step 3, calculate the taxes on 2,50,000 rupees, that is the agricultural income plus the basic exemption limit of the assessee. And in the step 4, finally, when you will calculate the taxes, step 2, that means here whatever amount of taxes you have calculated, from this tax you will deduct the tax calculated in the step step 3. So step 2 tax minus step 3 tax, whatever will be the result will be the tax payable by the assessee in such case. So the actual tax liability will be only on the non-agricultural income, but at the rate that will be applicable for the combined total in such a case. So this is known as the partial integration in case of the agricultural income. Now, the next list of the exempted income is the special economic zones. In these special economic zones also certain kind of exemptions in the calculation of total taxable income is allowed to the entrepreneurs and the corporates. So let us understand what is the meaning of the special economic zones and what different kind of benefits an assessee may receive under this rule. So section 10AA of the Income Tax Act includes the various provisions related with the special economic zones, and in this particular section various income tax deductions to newly established units are provided that are located into the special economic zones of the nation. So special economic zones are the various types of areas where government wants to promote and encourage industrial development. So any entrepreneur or business who set up a new unit and says after April 1, 2006 they can ask for such deduction. The unit must begin operation and manufacture of goods and services. So they must be engaged in manufacturing of goods and services. It must not be formed by splitting up or reconstructing the existing business. So you need to incorporate a new business unit for claiming deduction under section 10AA. Then it should not be formed by transferring old machinery or plant to any other unit. So beyond 20% of the total value cannot be transferred to the other unit for claiming the deduction under section 10AA of the SAYS. So what is the exemptions under this particular section? The exemptions under the section 10AA is available for 15 years to a new unit in the following manner. So in the first to fifth year, 100% of the profit from the export business are fully exempted from the taxes. Then from the 6th year to the 10th year, 50% of the profit is exempted from the export income, and from 11th to 15th year up to 50% of the income, provided that the amount is transferred to the special reserves of the company and used for the business expansion purpose within the 3 years of time span, is exempted from the taxes. So here you need to fulfill some conditions for claiming these deductions. You need to audit your books of account. Deduction is available only on profits derived from export business. So if you are doing your business only on a domestic level and selling your products and services in the domestic level of the country only, then it may not be allowed to you. The unit must file income tax return on time to claim the deduction, and the unit must submit the form number 56F for claiming such deduction under the Act. So this is the exemptions related with the special economic zones. So under this lecture, we had a knowledge of all the different aspects related with the tax exemptions and tax deductions. So we now are capable to understand that exemptions are basically the certain category of income that may not be included while calculating the total taxable income of the assessee, whereas deductions are the certain reliefs to the assessee. That means they may be partially or fully deducted after calculating the gross total income of the assessee for the purpose of calculating the total tax liability of the assessee. So while calculating the total tax liability, you need to understand what are the different list of exempted income and what are the list of different types of deductions that may be available to an assessee, and accordingly after calculating and while calculating the gross total income, you need to deduct all these incomes from your total gross tax liability, so as to calculate and minimize, or you can say manage your taxes well. So in this way, if you will calculate your taxes, you will manage your personal finances in a well planned manner that will reduce your overall tax liability. It will help you to maximize your saving, and these savings can be invested into certain other economic opportunities that may again help you to maximize your capital formation. So in this lecture we had a knowledge of all these concepts. I hope this particular lecture will be helpful for you to understand how you need to ascertain your total tax liability and what are the ways with the help of which you can minimize your tax burden. So with this I conclude this lecture. Thank you.